Hi, my name is Eric Rothfeld, and welcome to our new series, SF Conversations. I'm joined by Melissa Chi and Adam Ott, both from Fitch's CMBS team. Today we're going to have a brief conversation about the CMBS market, so let's get started. 2024 has been a surprising year. Issuance has been up significantly in both the conduit sector and the SASB sector. Adam, can you walk us through what we're seeing?
Yeah, it's been an exciting year in the SASB space in particular. We've seen a significant increase in volume. 2024 year to date has surpassed 2023 issuance, and the focus is on high quality collateral, industrial portfolios, multifam, luxury hotels. On the conduit side, Fitch rolled out its new criteria in the second quarter of 2023, and the market seems to have adapted to it and integrated it into their pricing models pretty well. So that's conduit market has stayed steady. Deal volume is a little bit bigger. We're probably looking at 900 million on average, and the total number of deals in 2024 will surpass 2023. Fitch continues to enhance its presence in CRE CLOs, especially with the comprehensive collateral manager reviews. Fitch has rated 5 deals so far, actively engaged on 3 more, which we're excited about. And then another big surprise has been in the SFR, single family rental space, where Fitch has rated 10 deals so far this year. And a lot of that activity is refinances of 2019 and 2020 deals, as well as some new issuers as well.
It's interesting the impact to new issuance from the ability to refinance, particularly in a high rate environment. Melissa, maybe you could walk us through what we're seeing in the legacy transactions.
Even with the sustained higher rate environment, commercial real estate loan refinancing overall has been stronger than we expected for most property sectors. Outside of CMBS, we're seeing refi loans attract diverse lending sources, such as banks, life insurance companies, REITs, and also non-bank alternative lenders, including private equity and private debt funds. In the retail sector, greater risk appetite and more favorable lending conditions, have really helped a higher volume of anchored and shadowed anchored retail loans refinance. These properties mainly are stronger power centers and larger shopping centers that are in main retail corridors, and they really boast an attractive tenant roster of strong national retailers. And these properties have seen the ability to renew top tenants as well as attract new replacement tenants. In the multifamily sector, the refinancing has been really robust, and that's been driven by ample liquidity and also strong investor demand. We've seen successful refinancing of lower quality Class B and C product, affordable housing product that's generally securitized in our conduit transactions. They've been able to refinance successfully because of grants and funding from federal and state government, as well as incentives to spur private lending.
Among the property types, office has probably been under the most scrutiny, the most focus. What are we seeing on that side? Have office borrowers been able to refinance?
The uncertainty around future cash flow and also valuations and the scarcity of liquidity in the office sector have really diminished office refi prospects. We've seen very limited successful office refinancing, and the refis that we have seen are really for the rarefied properties, the top tier Class A properties in prime locations with desirable amenities that have been able to attract robust tenants and long-term leases, which have limited the lease rollover risk that I think we're concerned about. I think the majority of office loans will still face significant refinance challenges, particularly the Class B and C properties that are securitized in our conduit transactions in less desirable locations, as well as in markets that have high vacancy rates. As a matter of fact of that, we've seen, office loan transfers to special servicing and office default rates spike over the past year pretty sharply. Loan modification activity has picked up, and what we're seeing is about 1 in 3 office loans that don't repay at maturity getting modified.
Despite the performance issues for office, we're still seeing new conduit issuance include a concentration of almost 25% this year. Adam, what type of office are we seeing in new transactions, and how are we approaching the analysis of these deals?
Yeah, it's definitely been a cautious market when it comes to office loans in conduit deals. Echoing what Melissa said, right? The loans that we are seeing tend to be the higher quality, newer assets in core markets. And that's, when we're looking at them, that's what we're trying to determine. We're spending a lot of time looking at the rent roll, trying to understand the tenants, what that rollover schedule looks like, wanting to make sure we understand the tenant commitment to the space, their utilization. So that's part of like us getting our hands on that. Being comfortable with the market, where it's located, as well as what's happening in that sub-market, beyond just vacancy rates, availability rates, when space on the markets for sublease, leasing activity, all factors in. And then the other thing that we're focused on is structure. In order to maintain the occupancy at these office properties, landlords are going to have to spend either through concessions like free rent or giving that tenant some tenant improvement allowance and leasing costs.
Despite macro level concerns across commercial real estate, there are definitely some bright spots. Melissa, maybe you could talk us through where we've seen some cash flow growth and improvement in performance.
Yes, absolutely. We've seen growth, particular in sectors like hotels, which have rebounded pretty strongly post-pandemic, as well as growth in sectors in the multifamily and industrial sector. We may see a larger allocation of loan prepayments in these sectors as rates come down. We've already seen shorter-term floating rate industrial and hotel transactions come back to refinance after solid short-term growth. However, we're cautious to make sure that this growth is sustainable before we give credit to that value appreciation.
Well, with interest rates starting to rally and a rate cut expected soon and potentially more rate cuts in 2025, has that changed any of our expectations on performance, losses, et cetera?
A more borrower-friendly, lower-rate environment will definitely help loan refinance prospects, which actually helps reduce maturity defaults. This will help bring down our loan delinquency projections into 2025, which we expect to be increasing. So that'll help mitigate and maybe offset that increase. Also, with lower rates, it doesn't just help borrowers be able to sustain stronger debt service coverage ratios. It also has the ability to positively influence cap rates, which we've seen fluctuate over the past several years, leading to higher valuations. And that in turn can help lower loss expectations and contribute also to more positive rating actions than what our recent rating action trends may suggest.
Well, the market has clearly changed post-pandemic. Pre-pandemic, it was a historically low rate environment. Obviously, we've moved into a much higher rate environment over the last several years. Adam, maybe you could kind of walk us through what avenues borrowers have taken to seek out greater liquidity from the traditional sources through the conduit and SASB market.
Yeah, I mean, I think the conduit space has already seen a shift towards 5-year deals. Just 18 months ago, first quarter of 2023, the conduit saw its first 5-year pool. And at this point in 2024, about 70% of new conduit deals are 5-year pools. And I think for borrowers, they are exploring kind of different avenues for liquidity via either CPACE or some of the federal funding like TIFIA or RIF. And what those are doing is providing the borrower some flexibility, either longer repayment terms, lower interest rates, deferrable payments, and in some cases, little to no required equity.
Well, 2024 has certainly been a transformative year, and we will continue to monitor and follow performance trends. Thank you, everyone, for joining us today. If you have any questions or would like to continue the discussion, please send us a note at the address on the screen. Thank you for watching.